Hey everyone, welcome to the current webinar here. This is the top 10 tax mistakes that you may be missing that may be costing you thousands of dollars every year. I am Jake Adams, CPA, your director today. My company is Realtor Tax Strategy and Adams Accounting Services, both fairly new, but I've been working with taxes and accounting for the past 6 years. So well versed in accounting, taxes, and tax strategy. So I'm going to be talking today about 10 tax tips that could save you lots and lots of money. They may not apply to you, or you may not be ready for them, or just your personal cash flow or your business cash flow may not support the tax deductions that we're talking about today. But just keep a open mind, and anything that you think would work for you, please just keep in your back pocket when it does apply to you, or when you think that it could apply to someone else. You can definitely share it as well. So one thing I do have to let you know before we get started, that this is just for educational purposes only. As a tax preparer, I have to let you know that I have researched everything that we're discussing here today to the full extent of the tax code and the tax law. However, I can't give the information to you specifically to your specific tax situation. I'm giving this information as general advice that can be used by any small business owner, most specifically real estate agents. So again, this isn't for you specifically, this is just generalized. So let's go ahead and roll right into the top 10 tax mistakes that you could be making. First of all, I love the tax availability and tax deduction of hiring your kids. So kids are a great way to shift your income. And what do I mean by income shifting? Well, essentially what we're going to be doing is, let's say if you're at a 25% tax bracket and maybe you have 15% self-employment tax, that would put you into a 40% tax bracket, where essentially 40% of your next dollar is going to be taxed. So what we can do by shifting income to kids, we can take advantage of their lower brackets. And actually kids can earn up to $6,300 for 2016, and that is the federal exemption. Everyone has an exemption amount, which is $6,300 for 2016, and that exemption is tax-free for everyone. Only downside is we actually have to do a tax return for each of the kids that are being paid, but that's not really a problem. It's pretty quick to do a tax return for a kid. Couple things I have here on the slide. Kids as young as 5 can do everything from making copies to scanning and cleaning up. Typically, the IRS is going to want to see kids ages 7 and up. However, if we have full documentation, we can take advantage of the tax deduction a little bit early. I also have a mention there that there's no SE tax. That's your self-employment tax. That's going to be going to Social Security and Medicare. And this is only if you have a sole proprietorship or an LLC. This does not apply to corporations or S corporations. For corporations or S corporations, the children still have to pay self-employment tax, which is Social Security and Medicare. So essentially what you're doing is you're shifting your Social Security and Medicare to your kids instead of having it exempt. It would be exempt if it was a sole proprietorship or an LLC. We also have to run payroll for this, which means that they have to be paid in full by the end of the year. So we can actually double this deduction by contributing to the kids' college. We can do things like 529 plans, whole life insurance plans, or we can pay the kids, if they're on payroll, a little bit more. And by putting them on payroll and paying them a little bit more, they can put money into their own retirement plans. And in their own retirement plans, they can contribute, use that money penalty-free, not tax-free. Well, depending on the retirement account, it could be tax-free, but it'll be penalty-free when they go and take that money out for college, which is really beneficial. There's also some questions you'll have to ask your financial advisor as far as how does this work with FAFSA, student loans, if you're looking at getting student loans, scholarships, aids, that kind of stuff. So the tax benefit for this is not the only thing that you should be looking at. There's also many other ideas and qualifications that you have to think about before jumping into any retirement account, especially for college. So you may be asking yourself or saying to yourself, well, I don't have any kids. I can't take advantage of this. Well, they don't have to be your kids. You can use this for nieces and nephews and grandkids. Anyone that would come to your house and work or help you in your line of business can take this deduction. And you don't have to go up to the $6,300. You can pay them as much as you want or they have earned. And then, of course, that amount is then transferred to their tax bracket on their personal income tax. My next one is hire your parents. Now, depending on how old your parents are and what their income situation, this could or could not work for you. The maximum benefit comes from hiring your parents if your mom or your dad has experience in the industry that you are working in. So in this case, we're talking about real estate agents. So if your mother or father has experience in the real estate industry, that is perfect. A limited fixed income, either from Social Security or pensions or from investment properties, they shouldn't be at a very high tax bracket to take advantage of this. Because essentially what you want to be doing is shifting your income from your highest bracket to others at a lower bracket. So if your parents are at the same or higher income tax bracket than you are, then this wouldn't make sense. Also, you have to have a very good financial relationship with your family because family can have problems with money sometimes. So everyone has to be very open and communicative about money. So essentially what we can do and where the maximum benefit comes in is if you paid your, let's say, mother and or father $1,000 every month to attend your monthly realtor marketing meeting or your management meeting for yourself and your business. And essentially what you would talk about in that meeting is where is the business now? How are you going to grow the business? How many new leads you have? Where are you finding the most number of leads? How many commissions are you earning? And also, what is the status of the areas that you work in? So by having your parents attending these meetings and working through these meetings with you, it allows you to pay them a management fee, a consulting fee of, let's say, $1,000 every month for one of these meetings. Could be a couple hours. So then what we can do is then that money that's paid to your parents, they can gift it back to you. $12,000, $13,000. It's actually up to $13,000 a year. They can gift to you tax-free. So what does that mean? Well, essentially what we're doing is we're shifting the income, the earned income to your parents, and then they gift it back to you. So the money still stays in your pocket. However, the income is shifted to that person of a lower bracket. Could be your parents, could be anyone really. They just have to have some sort of relationship with you that you have, the financial relationship where you feel comfortable transferring money back and forth, and some sort of management ability. So they'd be able to consult with you or have some sort of discussions with you as far as the direction of your company or your professional career. All right, so number 4, track your miles. You're probably already doing this now. Maybe you use an app, maybe you use a logbook. Myself, I like to use a combination of MileIQ. I also use my calendar in Google. And then what I do is I compare both of them side by side in an Excel sheet at the end of the year. And I go through and I take both and then I cross out the duplicates and I make sure that I get every single mile. Because each one of those miles, if you're taking the standard deduction, is worth 56 cents. That can add up really, really fast. So you always want to make sure that you're taking full advantage of all the miles. If you're not using a log, I highly recommend upgrading and starting this if you're not already. The next thing I'm going to talk about is a home office. So the home office deduction is pretty safe now. When I say pretty safe, it's all about your risk and what you feel comfortable taking as a deduction. This is usually only worth a couple $100s for most small businesses and real estate agents. So in your case, the risk of having an audit or having someone question you about your home office is not worth the couple $100 it's worth. So really this is up to you as far as what you feel comfortable with. The nice thing about this deduction, however, is there's a new safe harbor regulation, which gives you about $5 per square feet. So if you have a room that's, let's say 100 square feet, that's part of your home that you use exclusively and regularly as your office, you can use that. You get $5 per square foot. So it's worth about $500 every year. It's not too bad. There's also a lot of travel benefits and auto benefits if you're using your home office, because you can take the write-off between your home and anywhere that you need to drive for business. However, if your agent broker office has an office for you or gives you an office, then you can't take the office and home. The office and home is only available if you don't have another office elsewhere. All right, continuing on. Number 6, client gifts and meals and entertainment. You may not know this, but client gifts are limited to $25 per person. You can give gift cards or any other items. And pens and promo stuff, anything less than $4 per item is considered advertising. So one big question that I normally get is on entertainment. A lot of clients ask me, what is entertainment? What is not? How can I take the deduction for it? So essentially the rule is if you discuss business anytime within 24 hours of the event, then the event can be considered meals and entertainment. If you don't discuss business with the client within 24 hours of the event, then it's considered a client gift. So I'll take a scenario of a ticket to a show, let's say an opera, and you've given these tickets to your client. It's $500 worth of tickets. So if you take your client out to dinner, either right before the opera or the next day or the previous day, take them out to breakfast or lunch or dinner, or have them come to the office, and as long as you discuss business within that 24-hour period, you can take the full deduction as a meals and entertainment. Now when I say full deduction, it's actually limited to a 50%. So if you give tickets worth $500, you can only take a $250 deduction. However, that's the full deduction for meals and entertainment. Again, you must talk or discuss business within 24 hours of the event for it to count as meals and entertainment. So the next one is for corporations only. As corporations, you can become an employee of the corporation, and any tangible item can be given as a service award up to $1,600. What are these tangible awards? They can be anything from watches to golf clubs to shoes, to anything tangible that you would buy yourself. Think of electronics, Blu-ray player, DVD, TVs, home theater systems. Those can all be employee service awards, either for safety or for length of service. And this can only apply for a corporation. Also, as a corporation, you can do employee picnics, holiday parties, de minimis items such as a turkey for Thanksgiving, or an employee picnic with bounce houses and fun stuff for your employees and their kids. And how many employees do you have to have? You actually only need to have one. You can be the sole employee of your corporation and take advantage of all of these things for yourself and for your family. You can also write off your trips to Costco, where you buy coffee, soda, and snacks. Also, if you have meals that are delivered to your office, you can take overtime meals and a bonus for working overtime. Occasional meals at your business if they're at the convenience of the employer. What does that mean? Well, if you're out till 7 or 8 o'clock at night working with a client, showing home, and then afterwards you have to go back to the office to work on some emails or to do office related things, and it's more convenient for you as the employer to have a meal delivered or to go out and get takeout and then bring that back to the office so that you can still conduct business throughout the evening, that is a write-off as long as it's an occasional meal at your business premise. You can also deduct athletic facilities. So if you have a home swimming pool or a home gym, or if you have workout equipment, treadmills, exercise, ellipticals inside your home, those can all be deductible as a athletic facility. You can also get $240 a year for a bicycle and bicycle expenses. There's hundreds more. I can't go through all of these, but employee fringe benefits are a huge write-off. Those fringe benefits are non-taxable to you. You actually get the write-off as a business deduction, and then when it transfers to your individual income tax, you're not taxed at the federal rate or state rate. You only pay Social Security and Medicare on these fringe benefits. All right, so continuing on, we have retirement plans. So retirement plans have long been an acceptable way to defer income taxes. Essentially what you are doing is reducing your income this year, or either paying the tax on it this year. And then when you take the money out for retirement, it's either tax-free or it's deferred taxes. So essentially, there's lots of different ways to doing this. There's SEPs, there's Simples, there's 401ks, solo 401ks, defined benefit plans, pension plans, 401k profit sharing, whole life insurance plans. There's lots and lots of these available options. The only problem with these guys is it is a long-term strategy. So it's definitely something that you need to look into and put as a long-term strategy and not a short-term strategy. So if you need this cash flow for your business or for your personal needs, for your family needs, you won't be able to take full advantage of this because this is a long-term savings strategy. All right, next we're going to talk about S corporations and C corporations. One question from a lot of people is, what entity should I choose? Is it an LLC, an S corporation, a C corporation, or should I stay as a sole proprietorship? And the answer is, it depends. And it depends on, number one, the amount of money that you have coming into yourself as a business. It depends if you have any employees, and it depends on how much work you do for the business. If your situation is that you don't have any employees, you're growing the business, the best tax strategies would be a sole proprietorship or an LLC. As you grow the business and you are able to have employees and you have the benefits of the employees working and creating a system for you, then the S corporation becomes the best tax strategy. And the reason for that is the profit that is earned by your employees and yourself working together and creating an efficient system is not taxed Social Security and Medicare. Now, the C corporation, just like we discussed before, is the Employee Recognitions Award. You can have a C corporation completely separate than an S corporation and LLC. There's absolutely nothing stopping you from having one of each. You could have an LLC, an S corporation, and a C corporation, and you have the benefits of each one. Only thing is, you have to have different business functions for each one. So maybe one is your professional real estate business, and one is a real estate holding company, and maybe another one is a marketing company, where you can then pay your marketing company, as let's say a C corporation, the amounts that you would be paying to marketing. This can be anything from social media to website design or advertising. This is, again, a fairly complex strategy, so not always going to apply to everyone. Some people want to keep everything kind of simple, just so it's easy to understand. So you really need to figure out what your comfort level is as far as the risk and the structures and the amount of business structures, which, if you have too many of them, could be confusing. So last and not least, my favorite, you can rent out your home to yourself completely tax-free. Why? Well, essentially in the tax code, there's a rule, it's nicknamed the Augusta Rule, which allows you to rent out your home for 14 days a year tax-free. There's absolutely nothing in the tax law that says you can't rent this out to a business. And if the business happens to be yours, that's okay. So what can your business rent out your home for? Well, it has to be used as a meeting or conference or event space. that's not directly related to customers or clients. This can be anything from a monthly real estate marketing meeting to a discussion on the current events or current changes in the market. This can also be used for trips, travel, vacation, and timeshares, where you can use a timeshare for a week to have a executive retreat where you talk about everything that's happened in the past year and what's going forward into the next year. All of these tax strategies are completely legitimate and allow you to write off your home or a vacation or a timeshare to pretty much anywhere in the world that you want to go. So I hope that was interesting, and I hope that you were able to get some good information from that. So how much would you save if you did even one or two or three of these strategies? Do you know what tax bracket you're in? If you don't, please watch the other video, which will show you how to determine what tax bracket you're in. If you would use one of these strategies, how much would that save you? Is it 25%? Is it 40%? Is it almost 60%? Could be thousands and thousands of dollars. And again, thousands of these tax strategies await you. There's 1031 exchange. There's Roth IRAs where you can invest in land, and as your investment grows, you can earn that money back tax-free. There's flipping. There's so many tax strategies that I can't cover in a single webinar. And it really is limited by your imagination and by asking questions of the tax code. So I want to thank you so much for joining me today. And I definitely really appreciate your time and sharing this with me. So if you have any other questions, feel free to contact me at jake@adamsabc.com. You can also reach me at jake@realtortaxstrategy.us. So you may be asking yourself, what's next? What can I do? Well, I actually have a 6-hour webinar course where I've discussed each one of these in more detail so that you can feel more confident about taking them as a deduction. I also offer that 3 to 4 hour financial meeting if you'd like to sit down with me via Skype or over the phone or in person. We can discuss your personal finances, your business finances, and where you see tax strategy playing a part in your life. Or you could do nothing. You could go back to paying way too much in taxes. The choice is yours. So briefly, my 6-hour webinar course, it takes an in-depth look at each deduction. We talk about meals and auto, travel, rent, inventory carrying costs, buying and building real estate, vacation homes, internet travel. If you're interested in that, it's $599 for the 6-hour webinar course. Feel free to email me and I can send you the information on that. If you'd like to work directly with me, I only take on a limited number of new clients. And I do this so that I can offer all of my clients individual results. So feel free to contact me at jake@adamsabc.com. And my promise and guarantee to you is that you will pay less taxes than my service costs, or it's free. I help all my clients make money, not spend money. So thanks again for being with me. Again, I truly appreciate your time and look forward to getting to know you better. Thanks so much.